Most people think a Federal Reserve rate cut is a blessing. Cheaper loans, easier mortgages, a chance for the economy to breathe again. That's the myth we've been told, the myth we're taught to trust. But history has a way of exposing comforting stories and replacing them with brutal truth. Because every time a major power, ancient or modern, slashes the cost of money, they aren't doing it out of generosity. They're doing it out of fear. Fear that the engine of their world is starting to sputter. Fear that the system they built is beginning to crack. Fear that time is running out. And the most shocking part? This isn't a new strategy. It's one of the oldest tricks in financial history. Long before America had a central bank, long before the dollar ruled the global economy, ancient empires used rate cuts, currency dilution, and cheap credit as tools of survival. Sometimes it worked, but more often, it simply delayed the inevitable. Welcome to Time and Money Tales, where money, power, and history collide, and nothing is ever as simple as it looks. A rate cut is not just an economic move, it is a redistribution of power. When the Fed cuts rates, it decides who wins, who loses, whose wealth rises quietly, and whose evaporates without a sound. A rate cut strengthens the asset holders, it weakens the savers. It rewards the borrowers, especially the biggest ones. It punishes anyone who still believes money earns a fair return sitting in a bank. And most importantly, a rate cut is a message, a whisper from the top of the financial pyramid. We can't afford the real cost of money anymore. That whisper has echoed across centuries because whenever a society reaches a point where money becomes too expensive to sustain the machine, the rulers lower the price, every time. Roman emperors did it, medieval Europe did it, and modern America, whether intentionally or instinctively, is following the same script. This is why understanding history isn't entertainment, it's self-defense. To understand why the Fed's rate cut matters today, we go back nearly 2,000 years to the heart of the Roman Empire. By the 2nd century CE, Rome was the most powerful entity on Earth. Its armies stretched from Scotland to Syria. Its trade networks pulled in gold, grain, spices, and slaves from 3 continents. But empires don't collapse when they're weak. They collapse when they look strong, but can no longer pay for their strength. Rome had a problem no one wanted to admit. The empire was too expensive to maintain. Armies were costly, roads were costly, welfare was costly, and the taxation system, once efficient, began falling apart as corruption spread. Roman emperors needed a way to keep everything going without raising taxes and risking rebellion. So they reached for the oldest button in financial engineering. They made money cheaper. But ancient Rome didn't have a central bank. They had something much more primitive and much more dangerous: currency debasement. Emperors slowly reduced the silver content in the denarius, creating more coins without adding more wealth. It was the ancient equivalent of lowering interest rates, increasing liquidity, and stimulating the economy. At first, it worked beautifully. Merchants traded more, soldiers were paid faster, cities expanded, life felt prosperous again. But that prosperity was a mirage, a thin layer of gold on cracking marble. Because cheap money solves problems until it creates much bigger ones. Rome learned a painful lesson, one today's world refuses to absorb. Cheap money always redistributes wealth. Always. The wealthy buy assets. When money becomes cheaper, those with wealth borrow more, buy more, and consolidate more. Land, mines, trade routes, tax rights. Rome became a civilization where a tiny elite owned nearly everything. The middle class, the backbone of the empire, vanished. Inflation turned savings into dust. As the denarius lost its silver, ordinary citizens watched their life savings dissolve. A coin that once bought a month of grain barely lasted a week. Families slipped into debt. Debt turned into dependence. Dependence turned into quiet resentment. Inflation is not chaos for the powerful. It is order. A system that transfers wealth from the poor to the rich without a single soldier lifting a sword. Cheap money gave Rome a temporary high, but it delayed the reforms that could have saved the empire: tax reform, administrative reform, military reform. The empire didn't collapse because it debased its currency. It collapsed because cheap money numbed its leaders into believing the crisis wasn't real. Now fast forward nearly 2 millennia. Rome had silver coins, we have digital dollars, but the logic is identical. When the Federal Reserve cuts rates, asset prices rise, just like Roman land prices did. Stocks surge, real estate jumps, corporations borrow cheaply to buy back their own shares. The wealthy, again, consolidate. Meanwhile, the middle class gets squeezed. Savings accounts pay less, bonds pay less, retirement returns shrink. Your money works harder for others while working less for you. The illusion of prosperity returns. Markets cheer, headlines glow, politicians declare victory, but underneath, the system grows more fragile, more indebted, more dependent on permanent cheap money. A rate cut doesn't heal an economy, it sedates it, and sedation is not the same as survival. This pattern repeats across history. Medieval kings lowered interest on crown loans to finance wars they couldn't afford. The Spanish Empire flooded Europe with cheap silver, sparking inflation that devoured the middle class. France, before the revolution, cut borrowing costs to delay bankruptcy. Peasants paid the difference. Weimar Germany lowered rates, printed money, and watched savings vaporize overnight. And the United States today cuts rates to support markets, prevent credit crises, and sustain government debt. Different centuries, different currencies, same mechanism, same outcome. Cheap money extends the empire, but at a cost. Here's the part most people never hear. The global financial system is built not on productivity, but on leverage, debt, borrowing, future promises collateralized against today's optimism. And cheap money is the oxygen of that system. When interest rates are low, governments can borrow endlessly. Corporations can refinance forever. Consumers can stay afloat a little longer. Banks can mask the true value of their assets. Cheap money doesn't repair the structure, it just keeps the lights on. And when an empire needs cheap money to function, it means something fundamental has broken. This rate cut is not an isolated event. It is part of a long chain of decisions that reveal the direction of the modern world. It signals that the real cost of debt has become unbearable. Governments can't afford higher interest payments. Neither can corporations. Neither can households. It signals that economic growth no longer comes from innovation, it comes from credit. Every slowdown is met not with reform, but with more borrowing. And it signals that the system is addicted to cheap money, and withdrawal would be catastrophic. So the solution becomes the drug itself. That is why the rate was cut, not to help you, not to strengthen the economy, but to keep the machine alive. One more cycle. Cheap money feels good. It stimulates markets. It lowers borrowing costs. It creates a sense of relief, like the empire has taken a deep breath. But historically, cheap money has always been the beginning of the end game. Not a collapse, not a crash, but a transition. A moment when a civilization quietly admits, we can no longer run this system at full price. Rome said it with debased silver, we say it with rate cuts. History doesn't repeat, but the incentives do. And if you understand the incentives, you can understand the entire system. Financial literacy isn't just knowledge, it's survival. It's resistance. It's the only weapon ordinary people have in a world designed to reward the informed and punish the blind. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.